So, NanoXplore, symbol GRA on the TSX, provides standard and custom graphene enhanced plastic and composite products to various customers in transportation, packaging, electronics, and other industrial sectors. The company has 11 production facilities across the US and Canada, as well as one in Switzerland. The end market for these products are driven by the energy transition. So, your EVs, your renewable sources, that's where they are targeting. The stock is down 21.6% over the past year to 239 a share, and that ends up with a market cap of 410 million Canadian. So looking at the last quarter, fiscal Q2 2024, which is December 31st, 2023, so they're shifted up 2 quarters. Revenue is down 8% to 29.1 million. The company does attribute this to a 6-week strike at one of the major OEM customers. The company believes that sales would have been higher than the previous year without the strike. The estimate for this variance is about $3 million. So the estimated revenue, if you remove their estimate of the strike impact, would have been $32.1 million, or about 1% growth year over year for revenue. Gross margins did improve to 19.4% from 17.8%, or up to $6 million from $5.9 million in the prior year. So that's gross profit at the $6 million. Despite the lower sales, which is good to see, as that reflects operational efficiency and maybe some economic scales of economics if they were to have higher sales, of course. So that is something you obviously want to look when these manufacturing companies over time is their margin improving for the gross profits, their operating margins. You want to watch that figure, because you'll see sometimes these companies, they just chase revenues. They're actually decreasing margins to chase those revenues as they're being rewarded off of revenue initially. That cannot be done in the long term, because you'll eventually need to be rewarded off of earnings, not just revenue. However, the company has increased its operating loss to a loss of $2.6 million from a loss of $1.7 million. R&D, SG&A, and depreciation all ticked up across the board. So that can be actually diseconomies of scale if you saw that completely just tick up over time and the sales are not outpacing it. So that's something you really want to watch. This was a bit of a weird quarter with that strike. So that's something you do want to track is SG&A, is R&D, and depreciation all ticking up at a higher rate than their actual gross profit over time. And that at least happened during this quarter. The company does guide for revenue of $130 million for the year, an uptick for the second half of the year due to the expansion of existing programs, adding another $30 million. And that would put likely still a loss, as they had a loss of $2.4 million, effectively no change for this last quarter. So just annualizing that, you're looking at really just $10 million, loss of $10 million or so. So then if you're adding another $30 million revenue onto their gross profit, even at that point, they're probably still not going to be profitable by the end of the year. But the company does have a net cash position, including their leases, of $5 million. However, this will shift significantly into debt, as the company will be taking on significant debt to execute its 5-year plan, which is expected to cost between $140 and $150 million. And that was actually reduced from previous estimates of about $170 million. So that's good to see a budget actually being reduced for a change. You don't see that common in either companies or governments. The company will have government support, but the exact details have not been announced at this time. So that will be something you want to watch out for, is how much is the government ponying up? How much are they going to actually have to raise? And what are the actual terms of their credit facility? And how long is the debt actually going to be on their books? So the 5-year plan is targeting to expand capacity significantly from 4,000 tons per annum to 16,000 in 2026, then to 20,000 in 2027 of combined graphene and battery materials capacity. The bulk of the capex is expected to begin to come online in 2026, which is for graphene and battery materials, which is expected to add about $140 million in revenue. The Lightwick composite factory for facility is expected to add an additional $80 million, which is expected to begin in 2025. Additionally, the company may see additional growth from its NanoXplore segment, which is graphene enhanced lithium ion batteries. Whether that adds additionally on, they haven't said the exact numbers. I think it's a bit up in there, because that is really the issue with these technology driven companies. They need to figure out the uptake, see how that figures into the financials, and going from there. So still probably a couple years out before they're going to have figures themselves. The company has had dilution over the past few years, but nothing unsustainable, which you do sometimes see in these emerging technology manufacturing companies at times. The substantial increase, which was in 2021, was related to acquisitions. So overall, the share structure really isn't a concern at this time. You're not seeing that hockey stick of share count increase, which is the opposite of what you want. The hockey stick, you want that in price, not the share count. So, but however, the company is still expensive, as the company does not have really any profit or even consistent positive adjusted EBITDA. They've had a couple quarters here, then they'll have a loss, and it's really trailing. It's near zero, which it just has a massive meaningless ratio at that point. But for price to sales, it's roughly at 3.2 times the forward sales, so their fiscal 2024 sales, which for a manufacturer is quite expensive even when you are profitable. Yes, the growth is expected to uptick in the second half, and they are going to see quite a bit in the 5-year plan. But they've also seen really no real growth organically over the past year. Even if you discount the strike, 1% is really meaningless when it comes down to it, when you are having such a high multiple. And if you're looking forward off the 5-year plan, it comes to a ballpark figure of 39% compound annual growth of revenue from the expected 2024 rate to 2027 and that would be putting them at about 350 million at the end of 2027. But that doesn't include any other additional organic growth, just those 2 additional facilities coming online. So whether or not they have additional or they even have contraction for whatever reason, that isn't included in that growth rate. As well, you don't know how much of that is going to actually trickle down to the bottom line, whether that's going to be their current 20% gross margin, or is it going to be 40, or is it going to be 5? You need to see that play out a bit more. So concluding, the company is speculative at this time. The growth has been lackluster over the past year, but the expected uptick is positive, as well as they have improved gross margins, which is good to see, but the growth is low given the current valuation, at least for their historic last year. But the real growth is expected to come with their 5-year plan, those 2 new facilities, and it is actually quite good growth looking forward, assuming they are able to hit those targets. But that is only for revenue for the company, and it needs to be successful. And by converting their revenue to the bottom line, they need to hit that cash flow as well, especially given that they are taking on debt to complete this plan. So they are taking on that 140 to 150 million in debt. In what form is up in the air right now. It is going to be in some sort of credit facility, but the exact rate hasn't been announced. But their current debt is upwards. It's between 6 and 9% for their actual normal standard financial debt. So you're probably looking at somewhere in that range of 7.5% or so. That's already a hurdle they need to pass to actually have any accretion on their bottom line. And that is always the worry when you are starting to take on debt. As well, of course, they are an emerging technology, so they have risk of competition, customer uptake. Are customers actually going to be able to buy up all the demand from the new facility? Because it's no use when the new facilities are at 10, 20% utilization. You have a whole big empty facility and you have to pay the overhead cost for that, but you're not getting enough sales. So you have to worry about that customer uptake. As well, you have general end industry slowdown. So notably the EV today, the Tesla announced 14,000 employees being laid off. So is that a sign that the EV industry is slowing? That's really the question at this time. But that is obviously a risk for NanoXplore if the EV industry does explore. It's not their only industry by any means. They do have other industries, stuff like power tools, even use that can potentially use the graphene batteries, and other industries amongst that, solar cells as well. It can be another one. But so it isn't dependent on the electric vehicle industry, but a slowdown would hurt them, is my point. So for now, I wouldn't really enter. I would wait to see how their 5-year plan really hits the financials, how those plants come online. Are they going to be accretive? And are they going to be able to overcome that expected debt load, and as well as customer uptake and sales and so on, and economies of scale? So for now, I really watch that. It's not a complete write-off in this case, like you do see. It's not the buzzword graphene or graphite companies, these which you see sometimes, which we've looked at a couple of those before, I think, on the podcast. So it's not one of those. It's one of these ones, though, which they do have potential, but you want to wait another couple of years to see how it pans out a bit more.
Yeah, and I would say at least this company does have sales, does have revenue. There is growth. There's a path of growth ahead.
Mhm.
our minimum criteria is profitability, cash flow. It's not there right now. And with this company, I would say your bet is on graphene prices long term, and if this company can be profitable, and your bet on whether or not the demand, you've seen this demand scale that says every year the demand for graphene is going to increase. Is it going to increase at that rate? And then are there going to be other suppliers that come in, and what is the supply demand situation going to be, and thus the price of graphene? So all of those things, which makes the business difficult to analyze, to be honest. And it's not that you can't analyze it, but you are forecasting greatly on this business when you're forecasting earnings going forward.
Mm-hmm. Yeah, they're right near that zero profitability right now, which is
Yeah.
why they might have a ratio quarter to quarter for some of them, but they'll be meaningless numbers. Just for anyone's wondering why I didn't put those out there.
Excellent.